Hello and welcome to the Strategy of the Week for the 12th of July. My name is Angel Clark, Director of International Sales. A lot of people tend to give up or get out of the market when a downturn comes along, or they suffer and watch their portfolio shrink while they hope that it ends soon. But actually, downturns can be your best friend as long as you know what to do and when to do it. We're going to cover both of these questions in this week's strategy using options to make money in a downtrend. Knowing about options gives you a huge advantage in the market. Options allow you to make money during up, down, or even sideways trends. They can help you dramatically lower your risk and your exposure in the market. They can provide you with insurance on the shares you own, and they can be a great source of income on the shares you own or want to own. You can even lower the volatility of your portfolio using options. Basically, if you're in the stock market, you'd have to be crazy not to learn about options. So let's get started with the fundamentals. When it comes to options, there are only two types: calls and puts. You can either buy them or sell them, which by selling them, I mean sell them short. We're just going to focus on the buying side today. Let's start with the call. If you buy a call, it goes up in value when the share price rises. The reason why is that a call contract gives you the right to buy that share at a price of your choosing, no matter how high the share price is at the time. The price you choose is called the strike or exercise price. That's the price your contract takes effect. Think of it as the price that you're striking a deal at. Exercise prices can be in the money, at the money, or out of the money, and you'll see them abbreviated just like this. For a call, an in-the-money exercise price would be less than the current share price. At the money would be equal to the current share price, and out of the money would be higher than the current share price. Now, if you buy a put, the opposite happens, and the value goes up when the share price falls. The reason why is that a put contract gives you the right to sell that share at a price of your choosing, no matter how low the share is at that time. So if you buy a put contract with a strike price of $10 and the share price goes down to $5, you still own the right to sell that share at $10, which is a profit of $5 a share for you. This means that for a put, in the money and out of the money would be the reverse of a call. For in the money, the exercise price is greater than the stock price. At the money would still be equal to the share price, or close to it, and out of the money would be less than the current share price. Remember, that's because you want to sell that share for more. As we saw when we were defining a call and a put, each contract gives you control over 100 shares, but at a fraction of the price that it would cost you to buy the same amount of shares outright. The big trade-off, though, is that you do have an expiration date on that control. The good news is you can decide how long or short you want that expiration to be. When you're looking at option pricing, you'll usually just see the name of the month to indicate the expiration, and that's because they generally expire the last Thursday of the month, barring public holidays. The minimum number of options you can buy is one contract, but of course you're welcome to buy more. Just remember that each contract controls 100 shares. Most of the equity ETOs on the ASX are referred to as American style. That means you can exercise them anytime before expiration. The other style is known as European style, and those options can only be exercised on the expiration date. With the American style option, you can buy and sell the option just like you would trade a share. You don't have to wait until expiration to sell and close your position. And just like with the share, the only risk you have in buying the option is the money you use to buy it. Today, we're just scratching the surface of learning options, but you can learn plenty more option details as well as frequently asked questions at the ASX website, and you'll see that on your screen. Also, if you want to see actual quotes, many Australian brokers offer options trading. You'll be able to look up quotes for options just like you would a share on their site. There will just be more of them because of the different expiration months available and the different exercise prices available. Together, all those prices make up what's called an option series or chain. To get an idea of options pricing though and just how much leverage they can give you, you can use the options pricing model in VectorVest. So let's jump into the program and go to the stock viewer. All we have to do is right-click on any stock. Then we go down to Calculate Options Price. Here's the current share price at almost $12.50. Here's our at-the-money strike price at $12.50. And then our expiration date. That's a little close. So let's be a little bit more realistic and go out to September. That gives us 76 days until expiration. So we would only be spending about $100 if we purchased a call or a put to control 100 shares of Magellan. This price is the price per share, so we'd want to multiply that by 100, the number of shares in one contract. But if we bought 100 actual shares of Magellan, then we'd be spending over $1,200, a pretty big difference. Now let's take a look at an example. I'm going to use a put as our first example because the most recent trend has been a downtrend. We only just received a confirmed up. So to put this into practice, it's logical that we would want to buy puts when VectorVest has signaled a downturn. So let's go to the market timing graph. You can see I already have it displayed here, and I've chosen the RT Kicker Combo signals. Let me just zoom into this last section. And you can see my marker is on a signal that occurred on the 30th of May. The reason I use that date is because a lot of people don't want to jump in on the first signal. But by this point, the market was clearly in a continuing downtrend. And it was the second signal to occur after a little relief rally. The other reason I use this date was just to demonstrate that you don't necessarily have to be at the very beginning of a trend to make money using options. Our next step is to find a share to buy a put on. To find shares that are likely to fall in price, it makes sense to use Unisearch and go to the Searches Short group. In this case, I've chosen Stinky Stocks to sell short. I'll change our date. And I'm also going to change to the options rate of return. This will allow me to screen for optionable shares, choose the type of option we want, and our expiration date. So for this example, I'm going to go a couple months out to July. We want to buy ourselves enough time to be right. VectorVest recommends at least a couple of months, and I'm also going to use at the money. VectorVest typically recommends in the money or at the money. With in the money, you tend to make money a little faster if the share goes the direction you expect. At the money is usually a little cheaper but slower. Since I'm in such an established downtrend though, I've decided to put a little less money on the line and go with the cheaper option. Before I run the search, I'll make a change to find the type of shares that are highly traded. These are usually the shares that have decent option volume as well. So I'm going to go down, choose Stocks, Price Volume, and go to Average Volume. I want greater than or equal to 1 million shares. Now I'll run my search, and we only found one stock, Newcrest Mining. If we had found more though, I would have sorted by the option annualized rate of return. That can help you find your best option candidates. In this case though, it's clearly Newmont. If we check the graph, we can see that Newmont is clearly in an established downtrend. And I'll even change the date to what we would have seen in May when we started this. So that's exactly what we would have been seeing had we checked this share on the 30th of May. Of course, we could have done this even earlier, which would have been fantastic the first time VectorVest gave this share a sell signal. But our date is starting way down here on the 30th. So at this time, Newmont is at $14.42. If it keeps going down, I should make money. And if it recovers and moves up, I'll lose money, but I'll never lose more than I paid for my option contract. To illustrate how this trade works, I'm going to use an add-on called Options Analyzer. This is available for a trial, a free 2-week trial. So if we right click, we can go to Analyze Options. We're bearish because the market is going down at this point, and we're going to choose a long put. When you're buying to open a position, whether it's a share or an option, that's referred to as being long. The Options Analyzer comes up. Here's NCM on 30th of May at 1442. Our expiration date is the 25th of July, and you'll also find this information down below. Currently, we're at expiration. I'm going to move this back to the beginning, and that's where you'll see the current strike price down here, as well as our current share price. It defaults to 10 contracts, but of course, you can just buy one if you like. The theoretical price that we would pay for that contract is 56 cents per share. So multiplying that by 100, we would pay $560. On the graph, our cost basis is shown here by this flat line. Here's our strike price, and this little square is where we would break even. That's when our value exceeds what we paid for this option. Up at the top, you'll see our maximum gain. That would be if the share went to 0, and our maximum loss. The only reason why it isn't the full 560 is because we have just a little bit of difference between our share price and our strike price. This is at the beginning of the trade though. At the end of the trade, our max loss would be the full 560. As the share price falls, you can see $10, then $5, and you can see our profit go up as the share price gets lower. So how much profit could we have made on this share based on the movement it had between May and now? Well, we can use trade simulation to get a very good idea. And of course, this trade worked out beautifully. Newmont did continue to move down. In fact, it went from $14.42 to $12.09. So it wasn't a huge move down. It was only $2 and change. That's a pretty small percentage if you had shorted the stock, but one you probably would have been pretty happy about. If you had the option though, you would have only risked $560 instead of $14,000, which is what would have cost you to buy 1,000 shares of Newmont. The option gave you the control without the cost. I can sleep pretty well knowing I only have $500 on the line. I might sweat it a little if I had $14,000 on the line. And you can see as of today's date, we have a profit of $1,850. That's more than 200% gain in less than 2 months. And of course, you can clearly see that as the market is turned up, we're starting to give back some of our profit in this option. Remember though, you can sell at any time. You do not have to hang on to this option until expiration. We could have sold here when we had a profit of $3,900. We could have even sold it a few weeks after we bought it when we were up over $2,500. How about when we more than doubled our money on the 8th of June, a little more than a week after we opened this trade, all with less than $600 of risk. Options are an amazing low-risk way to make money in a downtrend, and it just goes to show you that VectorVest has everything you need to successfully add a little options magic to your portfolio. Look for more of these strategies because this is only the beginning of using options to make money in the Australian market. That's going to conclude our presentation for today. I hope you enjoyed it and will visit VectorVest University for more great tutorials. Thank you and have a wonderful weekend.